Chapter 7. Banking and Inflation. Banking system of India has been acclaimed as one of the stable systems in the world. No wonder that the RBI has been managing the monetary policies well. But it is often faced with the challenge to choose between inflation control and monetary stability. Though the RBI has been revising its policies and guidelines more frequently now, the changing dynamics of the contemporary economic scenario has made it much more difficult to sustain the stability of the system. Banking system. Banking system is the pillar of an economic system. India's banking system is a stable one, under the supervision and regulatory framework of the Reserve Bank of India, RBI. In more than 6 decades of India's independence, the Indian banking sector has expanded and developed in multifarious dimensions. Types of banking. There are 3 types of banking, which are as follows. 1. Core banking. It is a banking service provided by a group of network bank branches where customers may access their bank account and perform basic transactions from any of the member branch offices. It is popularly known as Core Banking Solution, CBS, Cistern as well. There are 2 types of major banking services under core banking facilities. 1. National Electronic Fund Transfer, NEFT. The objective of the NEIT system is to establish an electronic funds transfer system to facilitate an efficient, secure, economical, reliable and expeditious system of funds transfer and clearing in the banking sector throughout India and to relieve the stress on the existing paper-based funds transfer and clearing system. Real-time gross settlement, RTGS. It can be defined as the continuous, real-time, settlement of funds transfers individually on an order basis without netting. Real-time means the processing of instructions at the time they are received, rather than at some later time. Gross settlement means the settlement of funds transfer instructions occurs individually, on an instruction basis. Considering that the funds settlement takes place in the book of the Reserve Bank of India, the payments are final and irrevocable. Banking and inflation. 69. 2. Retail banking. Retail banking is also known as consumer banking. In this system, bank executes transactions directly with consumers, rather than corporations or other bank services offered include savings and transactional accounts, mortgages, personal loans, debit cards and credit cards. The term is generally used to distinguish these banking services from investment banking, commercial banking or wholesale banking. It may also be used to refer to a division of a bank dealing with retail customers and can also be termed as personal banking services. 3. Narrow banking. It is also called a sale bank. Narrow banking restricts banks to hold liquid and safe government bonds. Loans would be made by other financial intermediaries, thus, the deposit taking and payment activities would be separated from financial activities. Commercial banks. All banks which are mentioned in the second schedule of RBI Act, 1934 are known as scheduled banks. These banks comprise scheduled commercial banks and scheduled cooperative banks. Scheduled commercial banks in India are categorized into 5 different groups according to their ownership and/or nature of operation. Apart from basic banking business, banks also undertake other services such as safe custody of valuables, granting and issuance of letters of credit to facilitate international trade, buying and selling in foreign exchange and collection of bills, among others. Banks also act as agent of the government and other entities to undertake agency business. Extending loans and advances to the needy sectors of the economy on a priority basis is a very crucial function of the banking sector. The first bank of limited liability managed by Indians was Oud Commercial Bank, founded in 1881. Subsequently, Punjab National Bank was established in 1894. Swadeshi movement, which began in 1906, encouraged the formation of a number of commercial banks. Classification of commercial banks. There are two types of commercial banks. 1. Scheduled commercial banks. Scheduled commercial banks in India are those banks which have been included in the second schedule of Reserve Bank of India, RBI, Act, 1934. Reserve Bank of India, RBI, in num includes only those banks in this schedule which satisfy the criteria mentioned in Section 42(6) of the Reserve Bank of India Act, 1934. Criteria for scheduled bank are: scheduled banks are those banks whose minimum paid up capital and reserve amount is up to 5 lakh. These banks have to submit details of their activities to the Reserve Bank of India every week. 2. Non-scheduled commercial banks. Non-scheduled commercial banks are those which have not been included in the second schedule of the Act. Non-scheduled banks are also subject to the statutory cash reserve requirement. But they are not required to keep them with the RBI. They may keep these balances with themselves. They are not entitled to borrow from the RBI for normal banking purposes, though they may approach the RBI for accommodation under abnormal circumstances. Other banks of India. The other banks of India are as follows. Public sector banks. The central government entered the banking business with the nationalization of the Imperial Bank of India in 1955. A 60% stake was taken by the Reserve Bank of India and the new bank was named as the State Bank of India. The 7 other state banks became the subsidiaries of the new bank when nationalized on the 19th of July 1960. Nationalized banks. From the 1st of February 1969, the government imposed social control on banks by introducing certain provisions in the Banking Regulation Act, 1949. Thus, now it becomes easier to understand that all those banks which were taken over through Banking Companies Bill are called nationalized banks. (70) General Studies, Mains, Paper 3. Government of India issued an ordinance in 1969 and nationalized 14 largest commercial banks in India. From the midnight of the 19th of July 1969, on the 15th of April 1980, 6 more banks having demand and time abilities of not less than 200 crore were nationalized. The undertakings of these banks are taken over and vested in 6 corresponding new banks under the Banking Companies, Acquisition and Transfer of Undertakings, Act, 1980. Later on, in the year 1993, the government merged New Bank of India with Punjab National Bank. It was the only merger between nationalized banks and resulted in the reduction of the number of nationalized banks from 2010-19. In the group-wise classification, since the 31st of December 2007, IDBI Bank Limited has been included in nationalized banks. Bank merger. Bank merger is phenomena where neobanks combine to form a single company. In recent years, Venus banking reform committees such as Narsimham Committee, 1991 and 1998, suggested merger of strong banks both in public sector and even in developmental financial institutions and NBFCs. In light of these reports and to enhance profitability and competitiveness of the banking sector, Finance Minister in August 2019 announced new set of mergers of public sector banks. After the merger, the country will have 12 public sector banks, which are Bank of Baroda, Bank of India, Bank of Maharashtra, Canara Bank, Black Circle Central Bank of India, UCO Bank, Indian Bank, Black Circle Indian Overseas Bank. Benefits of bank merger. Apart from providing greater ease of doing business, merger will also offer better economies of scale, efficiency, cost of funding and diversification of risk. Large and stronger banks will be easier to monitor for their efficiency in comparison to large number of individual banks. Besides, these banks with huge lending capacity will help investing in large infrastructural projects. F. B. Re. T. 20. The adoption of technologies across the amalgamating banks, bigger talent pool and customer database would help this merged banks to gain competitive advantage by leveraging analytics in a rapidly digitalizing banking landscape. These merged bank with better product and services will lead to enhanced customer experiences. Bank merger would help to create banks with scale comparable to global banks and capable of competing effectively both in India and worldwide. Issues with merger of banks. Merger will result in immediate job losses on account of large number of people taking VRS on one side and fewer recruitment on the other. This may worsen the unemployment situation and may lead to many negative socio-economic consequences. Bank merger will lead to creation of big banks. As seen from evidences of global financial crisis, collapse of larger banks hampers the entire banking industry. Whereas, small banks have better susceptibility to such risk because of their core area specialization. A study covering 20 years of bank consolidation in developed countries had provided mixed results. Further, India's past experience has not been encouraging. Solar. In the nutshell, merger of banks will provide Punjab and Sindh Bank, Punjab National Bank, Black Circle State Bank of India, Union Bank of India. Greater regulatory control to RBI, which will help in tackling stringent norms under Basel III. However, government has to ensure that they are merged with sole objective of promoting efficiency, competitiveness and further financial inclusion rather than to solve NPA crisis by merging underperforming one with better performing ones. Private banks. All those banks, where greater parts of stake or equity are held by the private shareholders are called as private sector banks. Assisi, HDFC, Axis Bank, Times Bank, Kotak Mahindra Bank and Yes Bank are important. Banking and inflation. 71. Private sector banks. Industrial Credit and Investment Corporation of India Limited was renamed as ICICI in December 1998. Recently, Reserve Bank suggested many guidelines for the establishment of private sector banks. They are as follows. Only Indian nationals can open a private sector bank. The minimum paid-up capital for bank can be 1.500 million. Within 2 years after foundation, bank should be listed in stock exchange. Bank cannot be established by companies engaged in stock market and real estate. Public sector cannot establish a private bank. Types of private banks. There are 2 types of private bank. Old private sector bank. The banks, which were not nationalized at the time of nationalization of banks that took place during 1969, are known as the old private sector banks. These were not nationalized because of their small size and regional focus. New sector bank. The banks, which came into operation after 1991 with the introduction of economic reforms and financial sector reforms, are known as new private sector banks. Banking Regulation Act was then amended in 1993, which permitted the entry of new private sector banks in the Indian banking sector. There are 23 Indian private banks right now. Foreign banks. Foreign banks are allowed to operate in India through branches and representative offices. A new foreign bank desirous of opening a branch in India is required to apply to Reserve Bank of India, giving relevant information about its shareholders, financial position and the dealings with Indian parties. Regional Rural Banks, RRBs. In 1976, the Parliament enacted the Regional Rural Banks Act, 1976, to provide for the incorporation, regulation and winding up of regional rural banks. The act has been made effective from the 26th of September 1975. The states and UTs where there is no presence of RRBs are Goa, Sikkim, Delhi, Chandigarh, Andaman and Nicobar Islands, Lakshadweep, Dadra and Nagar Haveli, Daman and Diu. The equity of the RRBs is contributed by the central government, concerned state government and the sponsor bank in the proportion of 50 hours 15 minutes and 35 seconds. Government of India undertook an exercise to amalgamate RRBs over a period of 5 years, reducing the number of RRBs to 56 as on the 31st of December 2014. The Regional Rural Banks Amendment Bill seeks to amend the existing act so as to increase the authorized capital of each regional rural bank, RRB, from 5 crore to 2,000 crore divided into 200 crore of really paid shares of 10 each. The bill also provides that the authorized capital of any regional rural banks shall not be reduced below 1 crore in shares in all cases to be fully paid up shares of 10 each. It also provides that the issued capital of CAH Rural Bank shall not be less than 1 crore. At present, there are 56 RRBs and they are doing well. The amendment to raise the authorized capital of the RRBs from 25 crore to 2,000 crore will strengthen these institutions and further deepen financial inclusion. The RRBs were set up in pursuance of the Regional Rural Banks Act, 1976, to meet the credit needs of the rural sector. Cooperative banks. Cooperative banks have also played a limited but important role in the banking system of the country. Scheduled cooperative banks consist of scheduled state cooperative banks and scheduled urban cooperative banks. There are AWO types of cooperative banks. State cooperative banks (SCBS) mean the principal cooperative society in a state, the primary object of which is the financing of other cooperative societies in the state. They obtain their funds from share capital, deposits, loans and overdrafts from RBI and can lend money to Central Cooperative Bank and primary societies and not directly to the farmers. Urban cooperative banks (UCBs) are registered under the Cooperative Societies Act of the respective state governments. UCBs having a multi-state presence are registered under the Multi-State Cooperative Societies Act and regulated by the central government. (72) Besides, the Reserve Bank also has regulatory and supervisory authority for bank-related operations under certain provisions of the Banking Regulation Act, 1949, as applicable to cooperative societies. The Banking Regulation Amendment Act 2020. This art was legislated in the backdrop of various incidents related to poor functioning of cooperative banks. Previously, absence of regulatory oversight by RBI on par with commercial banks has contributed to their dismal performance. Many cases of frauds and misappropriation of funds had also eroded the credibility of cooperative banking system. The Act provides for RBI regulation of cooperative banks with respect to management, capital, audit and winding up, Euler provisions of government securities or treasury bills. This Act RBI may prescribe conditions and qualifications for employment of chairman of cooperative banks. It can also remove a chairman nor meeting fit and proper criteria and appoint a suitable person. It may issue directions to reconstitute the board of directors in order to ensure sufficient number of qualified members. For cooperative banks, RBI prior approval is necessary to raise equity or unsecured debtor capital from the public. RBI can also undertake reconstruction or amalgamation of a bank without imposing a of those who stayed. Payments Bank. Payment bank is a type of differentiated bank which provides inking services to small businesses and low-income household. These banks were set up in 2016 after the recommendations of Nachikit Moore Committee on Financial Inclusion. The main objective of a payment bank is to further financial inclusion by providing small savings accounts and payments, remittance services to migrant labor workforce, low-income households, small businesses and other unorganized sector entities. There are two kinds of banking licenses that are granted by the Reserve Bank of India: Universal Bank License and Differentiated Bank License. C. 4. 1. N. S. T. B. M. S. M. N. B. N. As. Of. With. General Studies, Mains, Paper 3. Payments Bank comes under a differentiated bank license since it cannot offer all the services that a commercial bank offers. In particular, a payments bank cannot lend. It can take deposits up to 1 lakh per account and it can issue debit cards but not credit